Good morning. I want to thank the Futures Industry Association for inviting me to speak at your expo in Chicago. I'm only sorry that Hurricane Sandy prevented me from being there for my scheduled speech yesterday. It would have been my 4th year with you at Expo, and I'm glad that we could at least arrange for me to speak to you from a distance. As millions of Americans were affected by Sandy's devastation this week, we are all thinking of these families as they work to recover and rebuild. This week's natural disaster also tested the resilience of everyone working in the markets. I want to compliment all of the dedicated participants in the futures and swaps markets for the efforts in keeping markets functioning these last few days. All clearing and settlement functions worked smoothly. Many of the exchanges were open and up. This is a testament to clearing members, clearinghouses, exchanges, and the broad market. Through your planning, farmers and ranchers, producers, commercial companies, and financial institutions could continue to manage and hedge their risks. This week's weather disaster makes me think of an earlier disaster, albeit man-made, the 2008 financial crisis. As we rebuild from this natural disaster, we'll be examining ways to better protect the public from and be prepared for the next storm. After the 2008 crisis, we had to rebuild from a financial disaster. And similarly, we had to examine ways to better protect the public. And how better to do this but to go back to basics? What's the role of finance and financial markets but to allocate and price both investments and risk throughout our economy? The futures market traditionally and now the swaps market are at the center of that. It's to allow the public unfettered access to markets and information and establish prices transparently, free of fraud and manipulation. In sum, finance is about ensuring that the rest of the economy is well served. Though the markets and related regulation evolve over time, these goals have been met in the futures world for decades, and it's a compliment to those in this room that it has. But as the financial system failed in 2008, the swaps market, which had basically not been regulated, failed to meet these basic objectives of transparency and risk reduction. The swaps marketplace operated without these basic reforms, the reforms that Americans had benefited from since the 1930s. Those historic reforms that President Roosevelt and Congress came together on so long ago established a foundation of transparency, competition, and market integrity for the futures and securities markets. They also democratized our financial system, and it's led to many decades of economic growth and innovation. The 2008 crisis caused great damage. 8 million Americans lost their jobs. And just like with Hurricane Sandy, it affected millions of bystanders far and wide. In response, Congress and President Obama barred from the work done so many years ago and the work done by the futures markets when they looked and passed reform through Dodd-Frank Wall Street Reform and Consumer Protection Act, as what we all know as the Dodd-Frank Act. And your meeting here in Chicago is at a time of great change. As of October 12th, just 2 weeks ago, a new era of swaps market reform began. This will lead to significant benefits for the public. It also represents opportunities as well as challenges, no doubt, for the market participants in the futures world. But the futures markets have been rising to the occasion, and the participants in the industry are up to this challenge. I'd like to briefly review with you 3 key initiatives that commissioners will consider and hopefully finalize by the end of this year. These include the clearing requirement, the transparency reforms, particularly for pre-trade transparency, and the cross-border application of Dodd-Frank. I'll also like to review 2 other important items that we'll be seeking public comment on. One that's currently out to comment around enhancing customer protection, and lastly, ensuring for the integrity of benchmark interest rates. And as we work through these initiatives, I believe it's also critical that we continue our efforts to put in place aggregate position limits across futures and swaps as Congress directed the CFTC to do. So first, with regard to clearinghouses, They've lowered risk for the public and fostered competition in the futures markets since the 19th century, and they've worked well through thick and thin of wars, of Great Depressions, and the recent '08 crisis. Central clearing equalizes access to the markets and democratizes it by eliminating the need for market participants to individually determine counterparty credit risk. We've completed rules earlier this year that required transactions to be processed straight through to the clearinghouse, and this is a necessary step to achieve these goals. How does it do it? It compresses the time between a trade execution and acceptance for clearing, as our final rule said, as quickly as would be technologically practicable if fully automated systems were used. Why do I quote it? Because it's important. It helps level the playing field throughout the marketplace, particularly when we migrate to swap execution facilities and designated contract market trading for swaps. In July, we embarked on the last step towards clearing of standardized swaps when we sought public input on the first set of swaps that would be required to be cleared. And the initial set of clearing determinations for interest rate swaps and credit default swaps are in front of commissioners now, and hopefully we may finalize them in this month. If we were to do this, this would lead to the largest hedge funds and the swap dealers starting to clear as early as February, with other market participants being phased in throughout the summer of 2013. Secondly, transparency reforms. Of course, we all know they've helped since the 1930s to increase liquidity and competition in the futures markets, and they've helped benefit so many farmers and ranchers and financial institutions throughout our country. Such transparency, both before the trade and after the trade, levels the playing field by giving all market participants access to critical pricing and transaction data. As of October 12th, we've started to see some of this transaction information to the regulators as bright lights have begun to shine, with interest rate and credit derivative products being reported to swap data repositories. But by the new year, the public will also benefit from real-time reporting for these transactions, as well as for the uncleared swap transactions entered into by the dealers. This post-trade transparency will lower costs for the rest of the economy and help financial markets best serve their function. We also have in front of commissioners staff recommendations with regard to final rules on swap execution facilities and minimum block size. These two rules, coupled with rules on what's been known as Core Principle 9, will all come together and help promote pre-trade transparency to the swaps market, which ultimately means enhanced liquidity and price competition in the marketplace. And by moving trading of swaps to swap execution facilities or designated contract markets, all the participants in the market can view prices of available bids and offers and benefit from that. Such pre-trade transparency will build on the democratization of the swaps market that comes from clearing of standardized swaps and the straight-through processing associated with it. Thirdly, cross-border application of swaps. Comprehensive oversight of the dealers themselves will promote transparency and lower risk to the rest of the economy. With such reform a reality, we anticipate that many dealers will start registering on January 1st. By enacting such financial reform, Congress had in mind the crisis of 2008 and many of the very hard lessons we learned. They knew that when a run starts as part of the modern financial system, almost regardless of where it is around the globe, it invariably rapidly spreads to the entire consolidated financial entity. Then finance, rather than serving the public and serving the rest of the economy, can actually threaten the public and the rest of the economy. This was true when AIG, whose affiliate, AIG Financial Products, its business was basically run out of Mayfair in London. It was true a decade or so ago when long-term capital management's business was booked out of the Cayman Islands, even though they operated in Connecticut. These circumstances nearly bring down the U.S. economy, and I think Congress had them in mind when they passed Dodd-Frank. To give financial institutions and the markets guidance on this cross-border application, the CFTC sought public input in June on the interpretation of these provisions. And in consultation with the international regulatory community, the CFTC will move shortly to finalize the cross-border and phased compliance. Let me now just turn to two other items that we're seeking public input on, and you've all been very engaged in. First is the need to enhance customer protections. Segregation of customer funds is at the core of customer protection in the commodity futures and swaps marketplace. Last week, the Commission put out for public comment a proposal on enhanced protections for customer funds. And we look forward to all of your input on these reforms. These proposals are about ensuring that customers have confidence that their funds, when they post margin or collateral, are fully segregated and protected. It's a direct result of significant input from the public through roundtables and through market participants that we've gathered throughout the year. The work of the FIA has been crucial in this, and the National Futures Association and the various self-regulatory organizations. It would strengthen the controls of customer funds at futures commission merchants. The rules we put out to comment also would set new regulatory accounting requirements that would provide for stronger protections for customer monies held at the futures commission merchants, and would raise some of the standards for independent public accountants outside. It would also, at the federal level, put in place the rules that the NFA put in place this summer to enhance the protection of excess monies at futures commission merchants and provide regulators with daily direct electronic access to bank and custodial accounts of customer funds. But of course, we look for input from you all and the broad public on how this can best work. These rules build upon what we did earlier, late last year, regarding investment of customer funds through Rule 1.25, which we prevented the use of in-house lending through repurchase agreements. And they also build upon the so-called LSOC rule for swaps, which will be implemented this month. Let me just take a note on that. In light of Hurricane Sandy, the CFTC staff has gotten a number of requests in the last day or two, and we do plan to provide market participants a little bit more time in line with these requests, moving the compliance date from November 8th for LSOC to now November 13th, which would be the first day after the holiday. Before I close, I'd like to turn to what I think may be one of the most critical and challenging issues in the upcoming year. And this relates to benchmark interest rates such as the London Interbank Offered Rate, or LIBOR as we have all known it. It's a key component of our financial markets, and dare I say, they must work for the rest of the economy. And to do so, they must be honest and reliable. LIBOR is the reference rate for nearly half of the U.S. adjustable rate mortgages, but it is also the reference for nearly 70% of the notional amount of U.S. futures markets and for a majority of our U.S. swaps market. To say it's critical would be really almost understating its importance. There are four broad questions that the market participants and international regulators are focusing on with regard to benchmark rates. First, what are the best practices to ensure a reliable benchmark? Now, I've stated publicly and will continue to believe that a benchmark rate for any commodity or swap to be reliable and have integrity, it's best to be anchored in real observable transactions. It's only through real transactions entered into at arm's length between buyers and sellers that we can be confident that prices are discovered and set accurately. When market participants submit for a benchmark rate that lacks observable transactions, in essence, if there weren't those observable transactions, even if those submitters are operating in good faith, what would they look to? They may stray from real transactions and what the markets would really reflect. And when a benchmark is separated from real transactions, those that might not have such good faith, they might do other things, and thus the benchmark is more vulnerable to misconduct, certainly as we saw in the case that we settled this summer with Barclays. So the underlying market, it comes back to, is there an underlying market in London, however, for these interbank borrowings? And as we know, it's largely diminished. And some would say it's basically disappeared. The second question, in light of whatever we come together on best practices, and I've clearly stated that I think it has to have underlying transactions, In light of these best practices, how does the current survey benchmark rates measure up in comparison? Among other important questions, do they have sufficient numbers of underlying transactions to ensure their reliability and honesty? The Financial Services Authority from the UK addressed this point in part in their recent plan recommending reducing 150 benchmark rates to just 20, eliminating 5 of the currencies and 11 of the maturities of the remaining currencies. So thus, there's 130 rates or maturities that they recommend would be eliminated. Third question is, what alternatives might there be for interest rate benchmarks? Possibilities include overnight index swap rates or benchmark rates based on actual short-term financings between financial institutions, but there may be other alternatives, and market participants will largely decide this. Lastly, how do we ensure for a smooth transition from benchmark rates that may have become obsolete if the market moves to an alternative rate? For instance, for the 130 rates that the UK FSA suggests go away, how does it transition to something else? There have been circumstances in the past, albeit in smaller markets, such as in the gasoline markets, when benchmark rates have become obsolete and a transition was put in place. And maybe there's some lessons there. We do have several international organizations that will be coming together recommending approaches and next steps. And I encourage all of you to participate in these consultations. One of those organizations, IOSCO, or International Organization of Securities Commissions, has set up a task force that will be seeking public input on possible mechanisms and protocols that would best ensure for a smooth transition if and when needed. And I hope that these public discussions and efforts lead to benchmark rates that best serve the rest of the economy as honest and reliable reflections of the underlying markets to which they refer. Bringing it back to basics again, the role of finance is to serve the rest of the economy. The futures market has done so for decades by providing price discovery and liquidity through transparent and competitive markets. It's done so through central clearing as well. Now, the CFTC has a bit of work yet to do, and we're still sorting through the man-made disaster of 2008, which highlighted the need to bring similar reforms to the swaps market. But with the passing of October 12th, swaps market reforms are now becoming a reality. And I want to thank my fellow commissioners, Jill Summers, Mark Wiegand, Scott O'Malley, and Bart Chilton for all the efforts they've put in, and all of the staff of the CFTC for helping make these realities come forward. I want to thank you again for inviting me. I'm just so sorry that I wasn't able to be there in person. And again, my thoughts go out to all those families working through rebuilding the devastation after Hurricane Sandy. Thank you.